Okay, good morning, everyone. Thank you very much for joining me on this webinar. Today, we're going to talk about a holistic approach towards exit planning. I wanted to really start a series of webinars that are going to cover off from an educational perspective what exit planning is about and what a holistic approach might look like. And I think this is useful information to both advisors and to business owners. So thanks for joining me. My name is David Prowse, and I'm a chartered accountant by background, CPA, so a member of CPA Ontario, CPA Canada, also a member of the National Association of Certified Valuation Analysts, which is based in the US, a member of Exit Planning Institute in the US, and the American Association of M&A Advisors. And I'm the principal of Valorum Business Advisory. And Valorum Business Advisory, our focus is on valuation advisory, growth and exit planning, and corporate finance, which is specifically CFO services and M&A support. I don't do, not an intermediary, but I will kind of act in the role of kind of CFO for, as we get closer to the M&A transaction. So today we have about 7 things that I want to cover off. This is our agenda today. Number 1, what are the problems facing middle market business owners, and how can we as advisors help them out? What has traditionally been the problem with traditional planning, and maybe what are some solutions to that? Number 3, what is value acceleration? If you go to my website, it's valueacceleration.ca. So what is that about? Fourthly, what are the 4 types of owners? What are their and how are they different from each other? And how, as we as advisors, can we help them out perhaps in a different way? Number 5 talks about exit planning being a process, not an event. And we'll get into what the process might look like. Number 6, what is the role of an exit planner? It's not a necessarily well-defined role here in Canada, and I think so. I think it's worthwhile kind of getting into some of the specifics of that. And then last but not least, we'll round everything up, and we will put the pieces together. Okay, so the first issue we want to talk about is what problems are facing the middle market business owner. Okay, so I'm a member of the Exit Planning Institute, and that's based out of Ohio. And the Exit Planning Institute started in 2007 by a man named Peter Christman, and he wrote a book called the $10 Trillion Opportunity, which is a good book that you should check out. And he later sold that business to the current owner, who is Christopher Snyder. So Christopher Snyder, He's an exit planner based out of Ohio, but the Exit Planning Institute provides educational webinars and educational facilities for those who are involved in the exit planning process. So they started doing what was called the State of Owner Readiness in 2013. They have done multiple studies since then. The original study was based in Ohio and was originally collaborated or put together through the help of UBS, and they have done multiple kind of studies in different areas, but and they roughly all say the same thing. So we're just going to cover off on one, because I think the point can be made just by focusing in on one. So research has shown that most business owners have not adequately planned an exit from their business. And there's generally been a lack of consideration given for 3 types of readiness issues. So and we're going to talk about them: personal readiness, financial readiness, and business readiness. And the one thing that I also want to kind of add to this is that, really the concept of, how many business owners understand the valuation of their business, and more importantly, what does that really mean? because the valuation of the business is based on, value drivers. It's based on a lot of factors of what might be going on in the industry. But it's relevant, to the discussion here today is that, you as a business owner really should understand what the valuation of your business is. So that's something that's really one of the big holes, so, in existing education. So in this State of Owner Readiness Report, I think this is coming from 2016, 76% of owners plan to transition over the next 10 years. Okay. And that represents $10 trillion in wealth. So if we take your usual 10 to 1 ratio of US to Canada, I mean, you're probably looking at about $1 trillion in wealth that's going to be transitioned over the next 10 years. Okay. 49% have no transition plan whatsoever. And we'll get into a bigger breakdown of that. More than 70% of businesses that are put on the market do not sell. If you talk to a business broker or an intermediary, especially a business broker for smaller businesses, that number is probably even higher. Probably could be as high as 80 to 90%. Okay, so why is that? It's because there's a transferability issue. Okay, so transferability is very important. And only 30% of family-owned businesses transition to the second generation, and only 12% survive to the third. So anybody who's, gotten involved with, family businesses can understand some of the grief here. And it's not that transitioning to the family is a bad idea. It's just that if you're going to do it, if that's what's important to you as an owner, you shouldn't be naive about what the risks are. Okay, and it probably means that, yes, there's some work involved to make that transition successful. Here's some other statistics. Have you completed any formal education related to the transition of your business? As you can see, 2/3 said no. So there's a huge education gap there that we as advisors can help to fill. What best describes your company's transition plan? So here's some statistics based on different age groups. And it's no surprise that on the 40 to 49 group, you have the largest amount that said they didn't do any planning whatsoever. So there's really kind of four categories. There's, owners have done absolutely no plan, and that's like 50% overall. About a third said that they have a plan, but no documentation and not communicated to key stakeholders. Okay, so to me, when you say you have a plan, but you haven't documented it or haven't communicated it, it means it's sitting up in the owner's head, and it may be very fluid. It may be influenced heavily by emotions. But the point is that you probably haven't done very much in terms of moving towards executing that plan, because it's never been written down, never really been committed to, never really been discussed with anybody. Okay, so the third category there, 5% have done a plan, have done the documentation, or at least committed to paper, but have not communicated to key stakeholders. And key stakeholders probably would be like, the shareholders, employees, management, maybe, if the family's involved, members of the family, key advisors, perhaps. And then only 12% said they have a plan, documentation, and communication. If we take a look at the four different categories, so again, like I said, 40 to 49 looks like a good 70% there have of that category have done no plan whatsoever, and probably about 80% have either no plan or have done a plan but not documented, not communicated it. Okay, in the age 50 to 59 group, about 50% have no plan. And then, there's a large chunk there that's, looks like about 40% said that have no plan, have a plan, but no documentation, no communication. So like that's about 90% that are effectively done nothing. And only a small small percent there have done in the green area, and a little tiny sliver there for the planning. So that's a, you know, and in the age 50 to 59 group, you're probably not that far away from transitioning. You know, 60 to 69, you still have well over 50% there that have no plan or a plan but haven't documented it. And even on the age 70 group, over 50% have not committed that plan to write it. So, you know, it's questionable just how far along they are and how ready they are to exit. So what are some of the readiness issues? We talked about, we said there's 3 categories of them, okay? And this is something that's, you know, has been kind of overlooked in a lot of exit plans in the past. And so let's talk about personal readiness. This is something that, you know, really can sideline the exit planning process or a successful transition. Okay, so when we're talking about personal readiness, we're talking about the owner's not thought about any sort of goals and objectives on a post-transition basis, and they have no considerations to passions outside the business. Okay, so those are probably the 2 key points. And the reason why it's important is because what ends up happening is that for a lot of owners, because they haven't thought about it, you know, like they've probably been, you know, the mindset where they put 60 hours plus a week, 6 or 7 days a week, you know, into the business for many years. And that's their life. You know, they love networking. They love being part of the Chamber of Commerce and the trade associations and talking to customers, and they love all that. And all of a sudden that's going to come to an end, and they don't really know what to do with themselves. They haven't thought about it. And so what ends up happening is, you know, number one, the owners may just constantly put off doing exit planning because it's like a trip to the dentist. They just don't want to think about it. So if they don't deal with it, then they don't have to worry about the post-exit world. The second thing that could happen is that they get close to the exit, like maybe like, you know, they're going to transition it to a third-party sale. And what they actually end up doing is self-sabotaging the transaction because they don't know what this post-exit world looks like. They don't want to do it. So they end up basically, you know, kiboshing the deal. And then the third thing could be, yes, they do eventually go through and transition the business, but there's a huge amount of regret afterward because they didn't put any thought into it. So there's other things that go into readiness. So in other words, do you have an advisory board or a formal transition team? And again, who could be part of that? It's probably, again, your key trusted advisors, could be family members, could be peers. Really it's going to be very specific to the individual, but a number of people can kind of play that role. There's no contingency plan. So if you have, you know, key employees, or if you have like a major shareholder that's, you know, either majority or minority shareholder, but, you know, like they pass away, or, you know, if they're involved with the business, they, you know, like they're incapacitated, they can't continue as part of the business, and there's no contingency plans, then, you know, you're in a situation where the business really could either, you know, suffer greatly or potentially fail because there's no contingency plans in place. We also might see where shareholders or family members are not on the same page, and this can cause a lot of conflict. And a lot of times, because in Canada we have a really good estate freeze kind of regime, forced generational transfers can be something that are worth, can cause issues because the older generation assumes that the younger generation, the expectation is that the younger generation is just going to take it over. And there's not really any thought to, you know, does the younger generation, do they have a desire to take it over? Do they have the competency to run the business afterward? And also, do they have the financial wherewithal to actually carry out and purchase the company? Even on a phased basis, they may not be able to do it. So it may not be a realistic exit option. Okay, so other financial readiness is another type of issue, and this is something that would be very familiar for wealth managers would be very familiar with. So, what are the income requirements post transition? Has a needs versus wants analysis been done? The third point is incredibly important. Does the financial plan consider the value of the business? Okay, and I'll give you an example. So let's assume that an owner needs to have, I don't know, $5 million after all is said and done, after transactions, transactional costs, after taxes, and the financial plan. They have $5 million in a portfolio. That's what they need. But they go to figure out what the value of the business is, and after everything's been considered, the valuation of the business, after all said and been done, is only going to produce a net proceeds of $3.5 million. So in that particular case, you've got a value gap of $1.5 million. So what are you going to do about that? So that value gap means that, number one, you either have to reduce your expectations for how you're going to live your retirement life. Number two, you're going to have to take that money and maybe invest it more aggressively than you probably might like. Or number three, one of the other options would be you can improve the value of the business before you exit, so that you can at least ideally close that gap up or eliminate it completely. Okay, so that's what we're going to talk about when we get into like value acceleration. That's what we're talking about. We're talking about addressing the value gap. Okay, and then other things, wealth managers and financial planners will get into, like a net proceeds analysis. Tax planning is very important. So, for example, if you have real estate sitting in an operating company, chances are you probably should move that off to a separate company. If you're going to do a third-party sale, depending if it's going to be like a share sale, you would like to take advantage of your lifetime capital gains exemption. So again, if possible, so there might be some tax planning involved to get to that, to be able to take advantage of that. And on the tax planning side, what's really important to understand is that you can't just do that tax planning and then carry out the transaction, because under Canadian Canadian GAR rules, you can't do that tax planning in anticipation of a sale. So you usually have to wait a minimum of 2 years to let that tax planning kind of crystallize, and then you're generally kind of safe to kind of move on. So it just shows you that if you haven't done your tax planning, you're a minimum of 2 years away from exiting. Because the alternative is that you're just going to have a very unfavorable tax rate to deal with. And other things, again, on the financial readiness, are going to be risk sensitivity, and do you have a financial plan aligned with your personal plan? So, like, what are your plans? Like, do you want to move up to the winterized cottage? Do you want to go travel, etc.? So the last thing here, business readiness, is something that often really does not get addressed a lot in the exit planning process, but it's incredibly important. And a lot of times what ends up happening is the owner wakes up one day and says, I want to sell my business. And then they go to the business broker or the intermediary, and they come in and say, well, you're Mr. or Mrs. Owner, your business is not ready because of these factors. Or, they put it on the market and it just never sells. So, so we talked about like 70% just don't sell. Well, a lot of that has to do with business readiness issues. Okay, so what are we talking about business readiness? So number one, cash flow needs to be predictable and repeatable. So if you have a business that's it's very project oriented, and those projects are not recurring projects, that's an example of something where the work could just fall off the table one day. And so it's not predictable, it's not repeatable. So what is somebody buying in that particular case, right? This is something that's generally a very big problem with service companies, but it also could be a problem with could be a problem even with a manufacturer. Like if you only have one-time buyers or periodic buyers of your products, it's the same type of thing. You're always kind of like, working to kind of, get some more customers. Okay. What is your performance relative to your peers? So in other words, are you kind of industry average? Are you kind of in the bottom quartile? Are you in the top quartile? Because it makes a big difference in terms of valuation. If you're in the top quartile, you're going to get a higher valuation than you would if you're a laggard in your industry. Okay, so it's important to understand that. And if you're not there, how do you get there? We talk about the valuation multiple. We're going to talk a bit about that, but at the end of the day, valuation multiple is about risk and growth. What's the risk? What's the company specific risk? And the higher that is, the lower the multiple. And then, growth is, the higher the potential growth, the higher the multiple. The lower the potential growth, the lower the multiple. Okay. One of the most important things, though, is really transferability. Okay. And transferability, we're talking about personal versus commercial goodwill. Okay. So a lot of times, let's just imagine a business where the owner, wears all the hats, has all the personal relationships with its customers. If that owner were to disappear, the customers would say, you know what? I'm going to go find somebody else, because the relationships were all there with that person. And, there's none of the systems and processes of the business, like in terms of, its efficiency are documented. So it's all sitting up in the owner's head. So what is the, prospective purchaser comes along, what are they buying? It's all personal goodwill, right? So the idea is that, you need to, as part of the sales process or transitioning process, you need to move personal goodwill into commercial goodwill. Poor financial information is also a problem. So for example, do you have any insight or foresight into your business from a financial perspective? All right. Like, do you just look at your financials once a year when you're doing your taxes, or do you look at them on a regular basis? Do you know what your key performance indicators are? Do you have the ability to forecast or do a budget? Can you run different scenarios? Like, do you manage your working capital? Do you understand, do you manage your capital expenditures, your CapEx, if you're an asset intensive business? Like, do you have any idea, for example, like if you have customers, different types of customers, do you have any idea which customers are actually profitable or not? Do you have any insight into that? Okay, so that's the better your financial information, the more ready you're going to be and the more attractive you're going to be to somebody else. Management, family, succession issues. So the issues with management or family are going to be, again, are they capable of taking over? Are they willing to take over? Do they have the financial wherewithal to actually carry out the transaction? Those are the things you need to worry about if you want to kind of move in those directions. Okay. And as far as your customer base is concerned, how concentrated is your customer base? Do you have, 50% of your revenues tied up in 2 customers? Okay. The problem is that if those customers go bankrupt or they just decide they don't want to do business with you anymore, your business is going to be impaired. Okay. And the same issue applies. Take a look at your suppliers. Do you, on the supplier side, do your suppliers have the ability to kind of squeeze you with prices, or if they disappeared or, decided, they got disrupted somehow, like how would you be impacted? And then, some of the other issues would be like, is your ownership group at odds? Like, so is for example, are you going to have to worry about maybe doing, a shareholder buyout before you do an exit? So those are things that you need to think about. Okay, so what is the problem with traditional exit planning then? So I think traditionally the problem with exit planning is that it has been done in silos in the past. So a lot of times we've seen exit planning probably not even thought about at all in 50% of the cases. Okay, so and then we know that in many cases there's probably some tax planning, some insurance planning, some estate planning. But then the question is, is there a unified voice, or is this done by, 3 different groups of people who never really talk to each other and never really sit down in front of the owner? Because, it's, we haven't, there's really no unified voice. And the problem is that what ends up happening is that this causes confusion to the owner. And a lot of times the owner is going to be in a situation where maybe they get frustrated or they don't know what to do, and they end up doing nothing. All right. As we also mentioned, that there's been little to no thought about value creation or the potential value gap. Okay. And this requires a shift in mindset. So a lot of this is because just lack of education here in the marketplace. So this is something that we as advisors can help them with that shift. As we just talked about readiness issues. So there's been little or no thought towards readiness issues, especially I would say on the personal business side, not adequately addressed. Planning may be done, but there's no execution or follow-up. So it's nice that you've done a plan, you've got a nice report sitting in your desk, but if you don't execute on it and don't follow up on it, then nothing's going to happen, or it's not going to happen quick enough. And like we said, these things are processes, not events. So just doing the plan is really step one. The next part is, now you need to do A, B, C, or D. And sometimes there's a logical order to what you have to do. So there needs to be some form of execution, and ideally really someone to keep, hold some accountability and make sure that the follow-up's done. One of the other problems is that there's little thought towards addressing, growth-oriented owners. So not everybody's necessarily, that's fine. Not everybody's necessarily going to be thinking about exit planning at a given point in time, because maybe it's not really the number one pain point of the owner. But as we'll see, value creation can kind of address some of these growth-oriented owners, and I think through education, maybe give them some thinking on the exit planning side as well. Overall, there's just been really a lack of education to middle market owners, because if you go to business school and you take finance, we're talking about things like at a very almost kind of like perfect public company level. And the reality is that the middle market is all full of it's all full of holes. Usually the owner is very good at one or two things, but they probably lack in other areas. Right? They're probably amazing at business development, but not necessarily at building an organization. And no one's ever kind of sat down to tell them, like, okay, this is the structure here, and some of these things are things that you need to think about if you want to have a successful exit. So what are some potential solutions then? So the exit plan is created holistically with the collaboration of many trusted advisors. It would be helpful if there's one quarterback to bring the pieces together to present a common narrative to the business owner. And we'll talk a little bit about what the role of the exit planner is. There has to be a shift in mindset of the owners towards a value creation kind of mindset. All right. One of the systems we talk about planning and execution, one of the systems I use is kind of using 90-day sprints. I don't think there's any magic about it, but I think if you take a look at some of the like Jim Collins' book or Scaling Up or EOS or whatever, there's a bunch of them. But essentially, it's the same thing for like goal planning or whatever. The idea is really to kind of come up with some big goals, and then keep working your way back until you say, okay, this is my annual goal. This is what I'm going to work on over the next 90 days. And I think it's logically how I work about it, and it's kind of how I think about my business, and I think it's a good way to get the wheels rolling and at least start accomplishing things. Also, value creation, de-risking, we'll talk about that, can help address some of the concerns of lifestyle owners and growth-oriented owners as well. So it's not like there's just because someone says, well, I'm nowhere near exiting, doesn't mean that the conversation has to end. And I think at the end of the day, education is going to be really important. Like there's a huge education gap out there. So that's just something that we can all provide to to people in all sorts of different areas: strategy, leadership, entrepreneurial systems, finance, human resources, and operations. Okay, so let's talk about what is value acceleration. So when I talk about value acceleration, you might have heard the term like value engineering, value creation. Value acceleration is the same thing. Value acceleration is just a word that the Exit Planning Institute uses, but it's essentially the same thing. They're all talking about the same thing. Okay, and here's my definition anyways: a dedicated process undertaken by company management to systematically increase the value of a business through addressing, number one, the absolute size of a company's cash flows; number two, the risk associated with achieving those cash flows; and number three, the long-term growth rate of the company into the distant future. Okay, that's a little bit of an oversimplification, but at the end of the day, that's really what valuation is about. You know, it's about size of cash flows. It's about generating repeatable, transferable, recurring cash flows, and de-risking those cash flows. And then, at least, you don't necessarily have full control over the long-term growth rate of the company, because a lot of that's really kind of going, there's industry and macro factors involved. But number one and two, you do have control. Okay. So just like everything else, exit planning, estate planning, value acceleration is a process, not an event. It involves a mind shift from producing income to value creation. So, what ends up happening to, like, a lot of people, they start their business, what they care about is tax minimization, and maximizing their after-tax distributions out of the company. There's very little thought towards value creation, keeping that money inside the business to actually, produce a better business. And value acceleration, one of the advantages is it provides a roadmap for the owners to grow with an exit in mind. So it's helping them, giving them a pathway that they can follow over a certain period of time. And usually, we're talking about 3+ years. And it's flexible enough to address different priorities, including non-financial concerns that we've talked about. So I don't want to get hung up on these formulas, but if you see the middle one there, it's, most businesses are going to be, they're going to sell for, a cash flow value, which is usually going to be EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And then you're going to apply a multiple towards that. Okay. So the multiples based on really essentially, what's the risk of the business? What's the company specific, well, there's multiple factors of risk, but, company specific risk plays a role. Not all risk can be, you can't eliminate every single risk, but company specific risk you certainly can address. And by lowering that risk, you're going to increase the multiple by if you're a higher performer, say like, a top quartile a business, well, then maybe your long-term growth rate's going to be better than the average company. So again, that's going to impact your multiple. Okay. So, and if you take a look at those formulas there, just to let you know, K is the discount rate, and that's really just the risk associated with its cash flows, and G is the long-term growth rate. But really, the easiest thing is just think about the multiple times the cash flow. And that's really what's going on, is that, value acceleration, you're trying to maximize the cash flows and get as high a multiple as possible. Okay, and the most important thing really too is, again, correlate that business value with the other objectives, such as the financial objective. So we talk about, the value gap. Like you shouldn't just do the valuation in isolation. And then there's going to be, like I said, there's other personal objectives that you have to think about. So it's not just about value maximization. That's not what we're trying to teach, middle market owners, because there could be many other qualitative factors, such as, family, what's going on with stakeholders, what's going on with employees, what's going on with legacy. Those all have to be taken into consideration as well. And some of your exit options are going to not necessarily maximize value, but they may achieve other objectives. So, but at least you can make those decisions with an educated perspective. Okay, so what are we, when we're talking about value creation, what are we talking about here? So really, I would just say, in terms of, growth orientation, some of the factors we're talking about is like increasing top line growth. But what's important is it's not just increasing revenues, but increasing profitable revenue. So in other words, if we're going to bring in new customers or new business from existing customers, we want that to be profitable. Because I think sometimes, too many businesses are focused on top line growth, and they end up bringing in, unprofitable business. And so that's the opposite of value creation. It's value destruction by doing that. So by having a value creation mindset, you're going to increase your growth, but you want to make sure that it's profitable. Okay. The most important thing is really coming up with repeatable and transferable revenues. And this is really an organization. Well, it's both organizational and it's strategic in nature. So you got to figure out for your business model and how you structured your organization to help bring that about. You want to have diversification of revenue streams. Okay. That's also, again, strategic. So if you have 50% of your customers or of your revenues represented by 2 customers or even 1 customer, how are you going to address that? You need to address that. How are you going to address that? So that's a strategic thing. Efficiencies of operations and processes. Okay, that's a value creation activity. How are you using your intellectual property? Are you making full use of your branding or other intellectual property where, maybe number one, you can find different revenue streams based on your IP, or maybe you can, effective use of branding, for example, maybe you can get more premium pricing and therefore it's more profitable, and rather than being like a commoditized business. You could also focus in on, a market niche. So instead of trying to appeal to a wide, broad market and being kind of mediocre at it, you could be, say, I want to be a market leader in this particular market niche. Now, again, that's a very strategic thing, but some businesses will do that. Let us focus on a very narrow niche, but be very good at doing that. Getting the right people in place. Okay, that's important, because you don't want the owner doing everything. So you somewhere down the line, to have a transferable business, you're going to have other people doing some of the things that the owner's doing. Okay, so, and it's not just putting anybody in place, it's trying to think about it, put the right people in place. What roles do you need there, and who's going to fit those roles? And then think about the functional areas. And also, you need to be able to monitor key metrics and incorporate that into your decision making. So from a de-risking perspective, okay, organizational structure. So, if you've ever read, like Jim Collins, or, he talks a lot about, some of these things about, or scaling up, or EOS, like organizational structure are very important. Do you have, because I'll tell you, like a lot of middle market businesses probably don't even have an organizational structure. Top down and bottoms up communication. Top down communication is so the owner comes up, or management comes up with strategic direction, and then they communicate that down all the way down to the frontline employees. And if the communication is effective, everybody's on the same page. Bottoms up communication is, okay, well, you're getting some feedback from your customers, and that feedback goes all the way up to management so that they can take that information and do something with it. Okay, so because if something's going on and your customers aren't satisfied, but nobody in management they're either not getting that message or they're getting the wrong message, then you're just going to have bad decision making, or decision making being based off of bad information. Okay, so systems and processes are incredibly important. If you don't have any, then you need to design them. If you have them, you need to document them And then if you've documented them, you also need to keep monitoring them. So in other words, you need to have some sort of system, like, that's telling you, like, okay, how are these things working? What are our expectations? Are we, and how are we comparing against our peers? Because it's all part of, improving the value of your business, improving, its financial performance. There's a lot of services, functional services in the marketplace. Many of them are now available on a fractional basis. So HR, finance, IT, sales, marketing, those are all available now for the middle market. And then from a strategic perspective, going through a SWOT analysis, which is strengths, weaknesses, opportunities, or threats, or Porter's 5 forces. These are, SWOT is going to, tell you about, both positive and negative. What are some of the things that you should think about from a growth perspective, but also from a being defensive and de-risking. Porter's 5 forces is really about, these are the economic forces that are acting on your business. So again, it's a strategic exercise so that you can kind of avoid problems. And I just think in general, it's a de-risking exercise. Okay, so let's talk about the 4 different types of owners. Okay, so there's probably about 95% of owners are going to fall into the lifestyle owner category, and there's nothing wrong with that. That's not a value judgment, but a lifestyle owner is basically, they've created a job for themselves. It may be very lucrative. It may just be getting by, but that's a huge category of people, like entrepreneurs, are going to fall into that lifestyle owner. Okay, then there's the growth-oriented owner, just wants to keep growing, does not have exit planning on top of their mind at all, or it's like so really far back. And then you're going to have, the growth-oriented owner that does have an exit in mind somewhere, and they may not have a plan, but it could be somebody who's saying, yeah, I really need to think about exit planning. And then, like many owners, they wait, some of them are going to fall into the exit now type, who, they wake up one day and say, I'm tired. I want to go sell my business, and they go give a business broker or an intermediary a call. And, each of these owners has probably different ways that we can help them out. I think, like, for example, the lifestyle owner, the best way we can help them out is to make their life easier. So if there's a way to kind of separate that owner from the business somehow, and that could either be, through, there's some way to kind of like automate the business, or there's some way to, maybe put a layer of management or general manager in place, then that's something that could be appealing to them, because it gives them more time to do things that they like, or more time to kind of take a step back, and not get involved with the nitty gritty, but get involved with more strategic kind of thinking. And the way we can help them out is probably at the beginning is probably just going to be educational, small workshops. It's possible that the lifestyle owner may eventually grow into what I would say would be the growth-oriented owner, without necessarily an exit in mind. Okay, so the growth-oriented owner that doesn't have the exit in mind is going to be heavily focused on top-line growth. So what's important there is helping them apply value creation strategies so that top-line growth is going to be profitable. It's important to keep in mind that, like, if you're part of, like, the startup ecosystem, or like private or venture capital, again, there's a lot of money. Like, growing is very expensive. So there's, like in those type of situations where you have angel investors or venture capitalists, they're the ones who are continuously funding the growth. But if you're like a middle market business that's, growth oriented, like, okay, well, the bank probably might help you out a little bit, but at the end of the day, like, you've got some limitations on how that growth is going to be funded. So ideally, if you are worried about growing, it really should be, you really need to understand kind of growing it from a value creation standpoint. I think a growth-oriented owner can be converted to a grow and exit type owner. And I think all the services listed there, like valuation, value drivers, I think, on the financial side, financial planning and analysis, capital allocation, pretty much everything except for, pure exit planning is something that they're probably going to be interested in and can help them out. And then you're going to have the growth-oriented owner with the exit in mind. So that's pretty much, again, everything, including exit planning, is like an exit option analysis, thinking about, some of the readiness issues. Those are things that are going to be important to them and that can help them out. And, one of the things that you can think of kind of growing with an exit in mind. I mean, this is essentially how private equity firms kind of grow companies that they get involved with. The difference is in the middle market is that, private equity is kind of like a machine, whereas, for most of these middle market companies, there's going to be a lot of qualitative factors. They're going to take precedence over just pure return on investment. So I would say, for example, the difference between, 2 and 3, the growth-oriented owner without the exit in mind versus a growth-oriented owner with an exit in mind is just simply probably going to be timing and prioritization. And then you're going to have the exit now owner. The best way to help the exit now owner is probably through education, and maybe you can help them realize, okay, there's a little bit of value acceleration that can be applied to them. It's important to understand that when you do apply value acceleration to a company, you're ideally really need to be doing it for like 3+ years, because, if you're just doing it for like, 1 quarter or 2 quarters, you're basically doing window dressing to the company, but, the prospective purchaser is going to come along and not necessarily be fooled by that. So they're not going to necessarily give you full credit for that. Okay, so what is the role of an exit planner then? So first, let's talk about who the key participants are in the exit planning process. You've got a business valuator or value advisor. Sometimes that's what they're referred to as. The accountant giving you tax and accounting advice. Corporate lawyer is important. The estate lawyer, the estate planner is going to be important. Wealth manager, financial planner, investment manager are part of that process. Business coaches and consultants are going to play that role. Insurance specialists are going to play that role. There's a lot of family advisors or legacy advisors. They're going to play a key role, especially, if there's a really complicated family issues. Intermediaries, and there's different types, different names. You have brokers, there's, investment bankers. There's specialists that deal with, just ESOPs or private equity, fractional functional services. Like there's a lot of fractional services out there, sales, marketing, finance, IT, human resources, operations. Financial institutions play a big role, both the banks and the alternative lenders, because they're the ones who can help out actually like fund some of these initiatives. And then there's a role called the exit planner, which is, and have to pardon the sports analogy, but, a lot of times it's referred to as the quarterback, because it's the person who's kind of coordinating the different advisors that need to be brought in. So what is the role of an exit planner then? So the role of an exit planner is to holistically, draw up a plan. He or she is going to bring in the advisors when required. And again, this is going to have to be tailored to the needs of the owner. So, it's not about force feeding, different advisors onto them. It's about, it's about understanding what the needs of the owner are and bringing in the advisors who can help out at the right time. Okay. The exit planner is going to help out with the execution and accountability. So we talked about how, doing a plan is great, but you also have to execute it over a period of time. So the exit planner's role there is to really kind of help with that execution and accountability. The exit planner can help keep the advisors on point and with message. So So instead of having like 4 different voices saying 4 different things, it can be more of a uniform message. The exit planner is supposed to represent the best interests of the owner, so steer the owner towards the best result. For example, I'm agnostic towards the exit. I don't act as an intermediary. So whatever the exit of the owner is, I want them to be successful in heading towards that exit. This is a really important point here, but the exit planner can also play other roles, and they often will. So they can play the role of exit planner, but they can also be, in many cases in the States, you'll see, the accountant, the corporate lawyer, the wealth manager could play the role of exit planner. So it doesn't have to be necessarily be just a separate role. All right. So it really just depends who's the trusted advisor, who's kind of got that process rolling. You know, if I go out, I mean, I may initially plan on being the kind of play that exit planning role, but the reality is that, you know, someone else may be better suited to it. Like an example would be, you know, especially if there's family issues, I could see a family advisor kind of playing that role. So it really just depends. Okay, so you know, just like estate planning and every tax planning, any kind of planning, it's a process, not an event. So what I want to do is just kind of show you, this is a slide here coming from EPI. This is kind of explains how their process works, but there's really 3 different stages. So there's a discover stage, there's a prepare stage, and then there's a decide stage. So in the discover stage, that's where, you know, ideally a financial planner has gotten involved and assessed, you know, the personal financial and business readiness, or at least on the financial side. There's also needs to be a business valuation done, and based on the business valuation, it's also important to take a look at the, you know, business value drivers, and then sort of figure out, okay, well, what's the value gap, if anything. And the idea really of discovery is not to solve problems, it's to identify problems and then come up with a prioritized action plan. And that prioritized action plan is going to be based on a discussion with the owner. So it's not about us telling the owner how to run the business. It's about, you know, based on a discussion, like what's important to them, and how they want to proceed. And we can certainly always give them advice and give them strong recommendations, but at the end of the day, it really boils down to, you know, what are the priorities of the owner. Okay, the prepare stage is really about, okay, filling in the gaps on the personal financial planning side. It's about implementing, you know, business improvements and de-risking the business. Okay, and you know, we talked about the execution, like the system that I use tends to be like kind of a, you know, 90-day sprints. So you know, you do various different iterations over 90 days. You try to tackle a few things at once, but not everything at once. And the idea is really, you know, what you're trying to do is over time, you're trying to, you know, talk about assemble proof. Well, it's about, you know, it's creating a business case saying like, yes, this is working. This is improving the business. And, you know, after every 90 days, you have a bit of time to kind of reflect on, okay, has this worked and what do we still need to do? And, you know, really over like, you know, anywhere between say like an 18 to 36 month period is probably the prepare stage. And that's really kind of where you're doing like the actual execution of the value acceleration. And then at the end, you know, you decide like, you know, do I want to keep growing or do I want to exit? And, you know, ideally, you know, by the time you get to that decide stage, the owner is way more educated. You probably, you know, you're probably certainly in a much better position to do the exit. And, you know, if you want to, maybe you got reinvigorated, you want to grow the business. So then you go to like advanced value creation, which will either be like, you know, you're making strategic changes to organically grow the company, or maybe you're going to grow through, you know, buy side M&A, or, you know, you just say, yeah, it's time to exit. So you know, either doing your internal or external transition at that point in time. So here's kind of how I work. Different ways of doing it, but generally speaking, so I'm not gonna do the financial plan, but presumably they have a financial planner, a wealth planner who's going to help them out with that. If they don't, I would make the introduction because I think that's important for them to get started on it. So I would help them out with the business valuation. I do something involved with kind of like a value gap analysis, which is, you know, identify strong and weak value drivers. I would also help them out with the benchmarking, just to kind of see, you know, how are they relative to their, you know, peers in industry. There's also something called an enterprise value assessment, which is where we identify the range of potential values. So it's important, like every industry is going to be different. And, the range may start at like a multiple of 2, or it may start at like 3 or 4, just really depends. And then it may go all the way up into like, 7 or 8, but you need to identify the range. And then, with the other work we've done, then you can kind of see, well, where do we fall in that range? And then what, because it's part of, I guess, assessing what work do we need to do over the next, say, 2 to 3 years. I'll help them out with get them involved with like a very detailed questionnaire. So we'll do like an exit planning assessment. So we'll look at the options, we'll look at the business readiness, help them develop an action plan that they can start to execute over, right away. But it would be ideally addressing over the next few years. And again, remember, the objective here is problem identification, not to solve. Okay, solving is on the implementation side, and you're not going to solve all your problems overnight. And again, it's going to be done in conjunction with owner discussion and their own particular priorities. So the implementation phase is where multiple advisors get involved. So based on the work performed in section 1, then you're going to have these 90-day schedules. Again, don't try to fix 20 things at once, because you're probably just going to do a very bad job of addressing all 20 things. So pick 1, 2, or 3 things that you're going to address over the quarter, and try to improve them. And then you can kind of reset your priorities at the end of that 90-day stage. And that's useful because it helps you avoid what I call the shiny object syndrome, where you're always being pulled away because of fires. But the thing is, if okay, my objective is to get A, B, and C done this quarter, like, you're always going to have these fires to deal with, but you still have to remember, I need to do A, B, and C. But if you have 20 different things that you're always trying to do, well, you won't accomplish it, or you won't, you just be constantly pulled away and never address some of the important stuff. Okay. And what's important is that, as you improve the business, you're going to be like, you may end up getting unsolicited bids. So, if you're part of this process, then every quarter you're going to get a little bit better, right? So you're going to be much better positioned to, if you undertake a value creation strategy, to understand what the value of your business is, and to sort of assess, if you do get an unsolicited bid, is that a good offer or not? And who knows, maybe if you've done enough, you realize, hey, maybe that's an offer you can't refuse, and you're mentally okay with parting with, exiting your business, then, that's something you can think about. But like I said, multiple advisors here, not one person can do it all. And then the last stage, like I said, decide or grow. And that's where, again, you can get involved with either exiting your business, like you've talked about, or you could get into like kind of a, growth program where you do either concentrating on organic growth or buy-side M&A. Okay, so let's try to put all the pieces together and summarize what we've talked about. So what are the benefits of value creation? I think increased transferability, increased options to owner, always gives more options to the owner. So like the more valuable your business is, the more options you're going to have available to exit. And that's always a good thing. It's going to allow more time for the owner to focus on strategy and big picture issues, because you're going to be forcing them to, transition some of that day-to-day stuff away from their desk to management, or to, like a general manager. Understanding the multiplication factor and valuation is a very powerful thing. So that's something that's can really be invigorating for them. You can help them minimize or eliminate the value gap, which is incredibly important. It may ultimately end up re-energizing the owner. So like they may go through this process, and after a period of time, instead of being tired and want to sell their business, they may say, you know what, this is great. I'm having more fun running this business than I ever have. And maybe they decide, I want to go grow this business. I don't want to exit. At the end of the day, a value creation strategy helps to align the interest of owners, management, and employees. and really becomes the primary driver of organizational behavior. So it's, it's like I said, very different mindset from your traditional, minimize taxes, maximize after-tax distributions. It's very different. So what are the benefits of a holistic approach? It's going to consider both financial and non-financial concerns, as we've talked about. It can help the owner maximize value or, or address key legacy issues. There's a uniform message that's going to be more harmonious, less confusion. The focus is going to be on planning and execution over time. So it's process, not an event. And it's going to be flexible enough to address changes in circumstances. All right, so let's just draw to a conclusion now. So as we said, traditional exit planning, if done at all, has been ignored the potential power of value creation, okay? And a value creation mindset requires an owner to better understand the value drivers of the business and the value gap that's there between what they need it to be worth versus what it actually is worth, so they can exit their business and retire comfortably, okay? And increasing or employing a value creation strategy is going to increase their options. Okay, so implementing that is going to be done over a period of 90-day sprints or whatever period of time that you think is useful. There's 4 different types of business owners. Each one of them can benefit from a value creation strategy, although how they may utilize the information might be different. Some of them are going to be more focused in on education and smaller bit workshops. An exit plan should be done holistically to address both quantitative and qualitative concerns. No one person can deliver or do a piece of the exit or do every single piece of the exit plan. So it's going to require a bunch of trusted advisors, and it really should be somebody playing the role of exit planner or quarterback. All right. And at the end of the day, a holistic approach towards an exit plan was going to increase the odds of a successful exit for middle market owners on both a financial and psychological level. So there's my contact information. I want to thank you very much for listening to this broadcast. Best place, probably get hold of me through email, but my phone number is there as well. Please visit my website. I do write articles, usually about twice a month. I'm going to post this video, make it available for everybody. And as well, I'm planning on doing more educational videos in the future. So I will let everybody know about when they are available. I'll have that on my website. I'll have it on LinkedIn. And if you're on my mailing distribution list, I will let you know about it as well. So anyways, we're heading off into the holiday. So I just want to say thank you very much for joining me today. I appreciate it. I hope everybody has a peaceful holiday. So happy Hanukkah, Merry Christmas, happy holidays to you, whatever you celebrate. Hope you have a safe and happy end to 2020, and we'll talk again into the new year.